You filed your taxes, your CPA sent over the return, and there it was, a number you weren't fully prepared for. Not the income tax line, the other one, somewhere between $15,000 and $30,000, maybe more, sitting right there on your return. And if you're being honest, you're not totally sure what it is or where it came from. That number is your self-employment tax. And if nobody's ever sat you down and explained it or shown you how to reduce it, there's a good chance you've been overpaying for years. I'm Daniel. I help business owners stop overpaying the IRS every year, keep more of their profits, and finally start building real wealth. In this video, I'll show you exactly what a self-employment tax is and why it hits business owners so much harder than employees. I'll show you why most of the strategies you've probably heard about don't actually do anything to reduce your self-employment tax. And I'll walk you through the moves that actually help, so you can stop giving extra money to the IRS every single year. When you started your business, you took on a partner you never agreed to. This partner doesn't show up to work, doesn't help with payroll, doesn't worry about slow months or problem clients, or whether the equipment holds up. They take zero risk, but every single year, without fail, they collect their cut. That partner is the IRS. And as a business owner, the agreement is worse than you probably realize, because you're not just paying your share, you're paying theirs also. That's what self-employment tax is. Here's the simplest way to understand self-employment tax. When you work for a company, your paycheck gets hit with 7.65% in payroll tax, Social Security, and Medicare as the employee. What most employees don't realize is that their employer is quietly paying a matching 7.65%. The employee never sees this, never feels it, it just gets handled. When you own the business, there's no employer to cover the second half, so you pay both sides, the full 15.3%. At $150,000 in net profit, that's roughly $21,000 in self-employment tax alone, before you paid $1 of federal or state income tax. One more thing worth clearing up here before we go further. If you set up an LLC thinking it would protect you from this, it doesn't. A single member LLC is treated as a sole proprietor for tax purposes. The IRS doesn't care what it says on your business card. Self-employment tax applies regardless of what your entity is called. So now you know what you're dealing with. Here's where it gets important, because most of what you've heard about reducing this tax probably won't actually do it. I work with business owners who are exactly in this situation, earning good money, paying a tax bill that feels bigger than it should, and realizing for the first time that nobody's ever shown them what actually is available to them. If you stick with me, this is exactly what the rest of this video is about. Before we get into the list, I need to make one thing clear, because this is where a lot of bad advice lives online. There are two separate taxes on your return: income tax and self-employment tax. They are calculated differently, they hit different lines, and this is the part that matters. Most of the strategies people talk about only reduce one of them. Retirement contributions, health insurance deductions, the QBI deductions, these are all real and worth using, but they reduce your income tax, not your self-employment tax. If you've been told otherwise, you've been told wrong. There are only two things that actually cut your self-employment tax directly: reducing your net profit through legitimate business deductions and restructuring how you pay yourself through an S-Corp election. Everything else goes through your income tax. But if you've been carrying a, let's say, $20,000 bill for self-employment tax and wondering why nothing seems to move that number, this is probably why. The most direct way to reduce self-employment tax is to reduce the net profit of the business. Self-employment tax is based on what's left after your business expenses come out. So every legitimate deduction you take off your Schedule C, think equipment, software, vehicle use, home office, professional services, reduces the base that 15.3% gets applied to. This isn't a loophole. It's the system working exactly as intended. The IRS taxes net profit, not gross revenue. So if you're not capturing every legitimate business expense, you're paying self-employment tax on dollars you shouldn't be. This one doesn't require a restructure or a new entity. It just requires good record keeping and someone who's actually looking at your expenses with a tax lens, not just categorizing them after the fact. It's also the most basic lever, And for a lot of business owners, there's more sitting here than they realize. With the S Corp election, this is one of the biggest opportunities most business owners have never been shown. Now, here's how it works. When you operate as a sole proprietor or single member LLC, every dollar of net profit runs through Schedule C and gets hit with that full 15.3% self-employment tax. As an S Corp owner, you pay yourself a reasonable salary, and only that salary is subject to payroll taxes, that 15.3%. The rest of your profit comes to you as a distribution, and distributions are not subject to self-employment tax. Let's put real numbers on it. Say your business nets 150 grand. As a sole proprietor, you're paying self-employment tax on essentially all that, and that's roughly $21,000. Now run it through an S Corp. You pay yourself a $60,000 salary. Payroll taxes on that are about $9,200. The remaining 90 grand comes out as a distribution, and there's no payroll tax on that. Total payroll tax bill, about $9,200 instead of $21,000. That's roughly $12,000 back in your pocket every single year. Now, the honest part, an S Corp adds real costs. Payroll service, a separate tax return, bookkeeping. That could range from $1,000 to $3,000 or more a year, depending on your setup. Most tax professionals put a break even somewhere around $60,000 to $80,000 in net profit. Below that, the overhead can eat the savings. The IRS watches S Corp compensations pretty close. Paying yourself just $1 to avoid the payroll tax is not a strategy. It's an audit waiting to happen. Reasonable means what someone in your role, your industry, and your market would actually earn. But if you're above that break even and you're still operating as a sole proprietor or single member LLC, this is a conversation you need to be having. If you just ran those numbers against your own situation and felt something click or something might be missing, that's a moment most of my clients describe when we first go through this together. They've been in the business for years, paying the full self-employment tax on every dollar, and nobody's ever shown them that an S Corp election isn't complicated. It just requires someone who's actually looking at your structure with a plan in mind. Now, if you want to send an extra $12,000 to the IRS, feel free, they won't stop you. Now, another thing in regard to your self-employment tax, and this one's smaller, but it's real and it's automatic. So you should know about it. The IRS allows you to deduct half of your self-employment tax as an above-the-line adjustment on your return. The logic is straightforward. When a corporation pays its share of payroll tax, it gets to deduct that as a business expense. This deduction is the IRS's way of giving self-employed owners that same treatment. At $150,000 in net profit, that deduction is roughly $10,600. At a 22% tax bracket, that's about $2,300 back on your income tax bill. It's not life-changing, but it's money you're entitled to, and it should be on your return every single year. One thing to be clear about, this reduces your personal income tax, not your self-employment tax. The self-employment tax itself doesn't shrink, but this is a real deduction that flows directly from the self-employment tax you paid, and it belongs on every self-employed owner's personal return without exception. Here's what I see happen constantly. A business owner has a good year. They hand everything to their CPA in March, the return comes back, the tax bill is bigger than expected, and there's a penalty on top of it. Not because they didn't pay their taxes, but because the timing was wrong. That's not a tax problem. That's a planning problem, and it's completely avoidable. The business owners who don't get surprised in April are the ones who are looking at their numbers throughout the year, making moves before December 31st, when there's still time to do something about it. What actually moves the numbers is what you do before the year ends. If you want to know where you stand right now, how your current setup stacks up against the strategies we've covered in this video, I put together something called the Business Tax Efficiency Score. It takes less than 90 seconds, it's completely free, and it'll show you exactly which area of your tax situations have room for improvement. The link is in the description below. You can't fire the IRS as your silent partner. That's not on the table. But you can take control and negotiate the terms. And the business owners who consistently pay less in taxes aren't doing anything exotic or aggressive. They're using the tools that are already available. and they have someone who's actually looking at their situation and putting them to work. That's what tax planning is. It's not scrambling in April, it's making decisions on purpose before the year closes when there's still time to do something about it. If you're a business owner and you want to pay your kids for doing work in the business, this next video is for you. Hiring your children through your business is completely legal. It can save you thousands in taxes every year, and almost nobody's doing it right. Click here to watch that.